Hello and welcome. Today, we're unpacking one of the most valuable skills in investing, fundamental analysis. Have you ever wondered how investors evaluate a stock's worth beyond its price? This video will take you through the basics and give you some advanced insights to analyze stocks like a pro.
Let's dive in.
Fundamental analysis is all about understanding a company's financial health and assessing its intrinsic value. Unlike technical analysis, which looks at stock price trends and patterns, fundamental analysis evaluates the company itself, its revenue, expenses, assets, and overall market position. Why does this matter? Fundamental analysis helps investors distinguish between overhyped stocks and companies with real, sustainable growth. This approach gives you a broader, long-term perspective, helping avoid high-risk stocks and finding companies that may be undervalued by the market. The starting point in fundamental analysis is revenue, also called the top line. It shows how much money the company is making through its operations. But while revenue is essential, profit, also called net income, is even more crucial because it shows how efficiently the company turns that revenue into earnings after covering expenses. Let's break this down. Check if revenue is growing steadily or fluctuating. Consistent growth often reflects a strong business model. Declining revenue could indicate issues in demand or market saturation. Look at both the gross margin and the net profit margin. High and stable profit margins suggest strong pricing power and cost management, which are positive signs. For example, if Company A has $100 million in revenue with a 15% profit margin, that means it makes $15 million in profit. Compare that to a competitor with a lower margin. This can reveal which company is more efficient and likely has better profitability. Next, analyze a company's expenses to understand how well it manages costs. Expenses typically include operating costs, administrative costs, and any interest on debt. A great way to analyze expenses is to see if the growth in expenses is aligned with revenue growth. If expenses are rising faster than revenue, it could signal inefficiency. This ratio compares operating income to total revenue and shows the percentage of revenue that remains after covering operating costs. A higher operating margin reflects better control over costs. Compare a company's expenses and operating margins with industry averages. This helps identify if the company's expense management is competitive within its sector. Financial ratios are essential in fundamental analysis because they offer a quick, quantitative way to assess a company's performance and valuation. Let's explore some key ratios. The P/E ratio compares the company's share price to its earnings per share. A low P/E may indicate undervaluation, while a high P/E might reflect overvaluation. However, this must be compared within the same industry for meaningful insights, as industries have different average P/E levels. The P/B ratio compares the stock's market value to its book value. A P/B ratio below 1 might mean the stock is undervalued, but it's important to assess the quality of the assets. This measures the company's leverage by comparing its debt to its shareholders' equity. A high ratio could indicate that the company is heavily reliant on debt, which is risky during economic downturns. Companies with lower debt are often more stable, especially in turbulent markets. Look into the free cash flow, which indicates how much cash the company generates after capital expenditures. Positive and growing FCF means the company has the resources for expansion, debt reduction, or dividend payouts. The dividend payout ratio is also valuable if you're looking at dividend stocks. This ratio shows the percentage of earnings paid out as dividends, helping determine if the dividends are sustainable long-term. A company's industry and market position give valuable insights into its growth potential. To do this, check if the industry itself is expanding. Growing industries often support company growth, while stagnating industries may limit opportunities. Analyze whether the company has a unique position or advantage, such as strong brand identity, proprietary technology, or significant market share. These factors can make a company more resilient against competitors. For example, if you're analyzing a tech company, investigate how it stands against competitors like market leaders. Does it have unique features, patents, or a strong ecosystem of products that set it apart? These strengths are important for long-term growth. To wrap up, fundamental analysis provides a clear, comprehensive view of a company's financial health and market potential. It helps investors make informed decisions by focusing on the company's core metrics rather than just the stock price. But remember, fundamental analysis works best when combined with technical analysis, which helps you time your buy or sell decisions more effectively. If you have any questions, or if you'd like more videos on advanced financial analysis techniques, drop a comment below. Thanks for watching, and remember to subscribe for more in-depth investing tips.